We all know that governments are drowning in debt. But there's another debt crisis quietly unfolding in the background, one that could hit much closer to home: the record-breaking mountain of consumer debt. From soaring credit card balances to rising mortgage payments and the return of student loan bills, millions of Americans are feeling the squeeze. So, in today's video, we'll break down the data, unpack what's really happening, and ask whether a crisis could be brewing right under our noses. My name is Guy, and this is a video you can't afford to miss. Okay, let's start by getting our definitions straight. So, whenever you hear the word debt in the news, chances are it refers to government or sovereign debt, that massive figure in the tens of trillions owed by the US government, racked up through decades of deficit spending. Governments borrow by issuing bonds, promising to pay back investors with interest using future tax revenue, or, in some cases, by simply printing more money. But consumer debt is a completely different beast. This is the money that regular people like you and me borrow from banks, lenders, and sometimes the government itself. It's the sum total of all the credit cards, auto loans, mortgages, student loans, and buy now, pay later plans that keep the wheels of everyday life turning. Unlike government debt, which relies on a country's ability to tax or print money, consumer debt is collateralized by our incomes, our homes, and our promises to pay. And to put things into perspective, as of Q1 2025, total US household debt has reached a staggering $18.2 trillion. That is the highest figure ever recorded, and it touches nearly every American family in one way or another. But why do people take on consumer debt? Well, sometimes it's about making those big life investments, like buying a house or paying for college. Other times, though, it's about smoothing out cash flow between paychecks, handling an emergency, or simply trying to keep up with rising living costs. In the US, consumer credit has been woven into the very fabric of economic life. After all, it was the mass adoption of credit cards, auto loans, and mortgages that fueled decades of growth in the 20th century and created what many still call the American dream. But here's the catch. When government debt gets too high, the consequences are mostly felt in financial markets. Interest rates go up, the currency weakens, maybe investors get nervous. But when consumer debt balloons, the pain is felt on Main Street, so to speak. Defaults can mean losing your car, your home, or even your financial future. And when millions of people feel the squeeze at the same time, the ripple effects can hit the entire economy. So, while politicians in Washington, D.C. debate the national debt ceiling, millions of families across the country are quietly facing their own ceilings on credit cards, mortgages, and student loans. And by the way, if you're enjoying the video so far, be sure to smash that like button to help give it a boost, and if you haven't already, subscribe to the channel and ping that notification bell so you won't miss our next upload. Now, the first form of consumer debt is credit card debt. Credit cards have become a fixture of American life since the 1950s, turning what used to be a cash-and-carry society into one that thrives on plastic. For decades, credit cards promised flexibility and convenience, embodied by American Express's famous "Don't leave home without it" slogan.
But this does the business. The American Express card shows exactly who's who. Don't leave home without it.
But beneath the surface, credit card debt has quietly become one of the riskiest forms of borrowing in the modern economy. See, unlike a mortgage or a student loan, credit card debt is revolving. That means there's no set payoff date, just a minimum payment that keeps you on the hook, often for years. What starts out as a bit of financial breathing room can quickly snowball, especially since any balance you don't pay off in full each month is hit with an average annual interest rate of over 20%. In other words, if not done right, borrowing on a credit card isn't just expensive, it can be punishing. And the numbers are nothing short of staggering. As of Q1 2025, Americans owe more than $1.8 trillion on their credit cards, a sum that's grown by more than 50% since the pandemic-era lows of 2021. The typical cardholder carrying a balance now owes over $7,300, and nearly half of all adult credit card users didn't pay off their full balance at least once in the past year, meaning they let some of that debt roll over to the next month, piling up interest and making it harder to get back to zero. What's striking is that this isn't just about overspending on luxuries, however. Far from it. Surveys show that millions are relying on credit cards just to cover essentials like groceries, medical bills, and even utility payments. And it's not just traditional bank-issued credit cards making life more expensive. Retail credit cards, so think big box stores, fashion brands, or even your local hardware chain, often come with even higher interest rates, sometimes as high as 36%. They're pitched as a way to save a few percent at the checkout, but for those who don't pay in full, the long-term cost can be crippling. In fact, retail cards have become a major driver of consumer bankruptcies, as their high interest rates and hefty late fees can quickly spiral out of control. Now, the use of credit cards has been fueled by persistent inflation, wages that haven't kept pace with the rising cost of living, and, for many, the psychological trap of minimum payments. The pain of buying is blunted when you tap a card instead of handing over cash, and before you know it, those balances can quickly climb. But perhaps most telling of all is the fact that this problem isn't confined to one age group or income bracket. Yes, Gen Z and millennials are shouldering a growing share of the burden, often using cards to fill the gap between paychecks. But data shows that credit card reliance is climbing across the board. And there are already signs that people can't keep up. As of Q1 2025, just over 3% of credit card balances are at least 30 days delinquent, which simply means the payment is more than a month late. That's still well below the peaks seen during the Great Recession, but it is rising, and history tells us that when economic headwinds pick up, delinquencies can accelerate fast.
Well, hello there. I know you're enjoying the video immensely, but I just very quickly want to tell you about the Coin Bureau deals page. Now, if you're looking for some of the very best deals and promos in all of crypto, such as, for instance, up to $100,000 in sign-up bonuses and up to 60% in trading fee discounts on some of the top crypto exchanges out there, as well as insane discounts on hardware wallets and much more besides, then check out the Coin Bureau deals page in the description below. And now, back to the video.
Now, one of the fastest growing and perhaps most misunderstood debt trends of the last few years is Buy Now, Pay Later, or BNPL for short. BNPL has its roots in 19th century America, when furniture makers and local merchants would let customers take home a product and pay in installments. But what's changed is the speed and scale at which technology has brought this old idea into the mainstream. If you've bought anything online lately, you've almost certainly seen the option: 4 easy payments, 0 interest, and, at least on the surface, no strings attached. Their pitch is simple: convenience, affordability, and none of those high interest charges that come with traditional credit cards. It's no wonder BNPL services exploded during the pandemic as lockdown shoppers turned to online retail and used installment payments to stretch their budgets. But here is where the story gets interesting. Unlike credit cards, most BNPL lenders don't perform a hard credit check, and approvals are often instant. Now, that's great if you need new trainers or a laptop right away, but it also means millions, especially younger, lower-income or financially vulnerable Americans, have been swept up by the ease of deferred payments. According to recent data, about 1 in 5 Americans have used a BNPL service, with usage especially high among millennials and Gen Z. On paper, the industry looks like a win-win. Merchants love it because BNPL encourages shoppers to spend more and more often, sometimes up to 30% more per purchase. The providers, meanwhile, charge retailers a fee, and they make extra money from late fees if you miss a payment. For most users, as long as you pay on time, there's no interest. Sounds simple, right? Well, not quite. The hidden risk with BNPL is that it's incredibly easy to take on more debt than you can manage. There's no centralized reporting system, so you could rack up installment plans across multiple apps without anyone, including yourself, really keeping track. Unlike credit cards or traditional loans, most BNPL providers aren't required to report their lending activity to credit agencies. And as a result, regulators are increasingly concerned about so-called phantom debt, meaning unreported, under-the-radar borrowing that isn't reflected on credit reports. This lack of transparency means much of the debt flies under the radar, making it difficult for economists, lenders, and even consumers themselves to get a true picture of the risk. What's more, some estimates say the BNPL debt pile could hit $700 billion by 2028. And if you do miss a payment, that interest-free promise quickly evaporates. Late fees can be severe, sometimes up to 50% of the payment amount. Your credit score can take a hit and your debt can be sold to collections, just like with traditional loans. Some surveys found that over 40% of BNPL users had missed at least one payment, and close to 30% said keeping up with installments made them fall behind on other bills. All told, buy now, pay later may look like an easy answer to rising prices, but for many it's simply swapping one form of debt for another, often with less transparency and more risk than most shoppers realize. And we actually have an entire video on BNPL, by the way, which you can check out right over here. Okay, next, let's turn to the largest debt that most Americans will ever take on: the mortgage. Now, the word itself comes from Old French, literally a death pledge, which, if you've ever looked at how long it takes to pay one off, might sound about right. Now, a mortgage is a loan secured by property, most commonly your home. And mortgages have existed in some form or other for centuries, but it wasn't until the 20th century that they became the backbone of the American dream. In the 1930s, most people needed a 50% down payment in order to buy a house, and loans were typically short-term. But following the Great Depression, the US government stepped in, creating Fannie Mae and later Freddie Mac to make homeownership more accessible. Institutions we covered in more depth right over here. Now, by establishing these institutions, the government standardized the 30-year fixed-rate loan and encouraged ever more borrowing, helping transform the US into a nation of homeowners. Fast forward to today, and the numbers are simply massive. Americans owe a staggering $12.8 trillion on 85 million mortgages. That's nearly 70% of all consumer debt in the US. The average borrower now owes just under $150,000, and the typical home price hovers around $510,000, more than double what it was just a decade ago. But how did we get here? Well, the pandemic set off a housing frenzy as the Federal Reserve slashed interest rates to record lows. Millions locked in 30-year mortgages below 3%, sending home prices skyrocketing as buyers scrambled to get in before rates rose. This created what's now known as the golden handcuffs effect, with homeowners sitting on ultra-low rates reluctant to sell, even as market conditions change. As a result, inventory remains tight in most regions, but in 2025 we're starting to see a flip. Steady high rates have resulted in more homes for sale, and in many places, sellers outnumber buyers for the first time since the great financial crisis of 2008. So, what's driving this shift? Well, the main ingredient is mortgage rates, which have climbed to around 7%, the highest sustained levels in more than 20 years. For many, home ownership is increasingly out of reach. And as affordability plunges, sales volumes are stagnating, especially in markets that once led the boom. Yet it's not all doom and gloom. Most homeowners who bought or refinanced in the last few years are locked into those record low rates and have built up significant equity. In fact, US households hold over $34 trillion in real estate equity as of 2025. Only about 2% of mortgages are underwater, meaning the home is worth less than the outstanding loan, a far cry from the 26% seen at the depths of the 2008 crash. But that doesn't mean everyone is safe. Delinquencies are on the rise, with 0.7% of mortgages now seriously delinquent. That is, at least 90 days past due on payments, which is a jump from last year, but still below pre-pandemic norms. New foreclosures are up too, but remain just a fraction of what we saw during the last housing collapse. So, while the headlines might not scream crisis just yet, the reality is more nuanced, and the foundation of the American dream is starting to show some serious signs of strain. Now, if there's one form of debt that's become almost a regular part of life for millions of Americans, it's the student loan. At its core, a student loan is simply money borrowed to pay for higher education, with the promise to pay it back, plus interest, after graduation. But the origins and the problems go much deeper. So, let's rewind a bit. The modern student loan system was born from good intentions. After World War II, the GI Bill opened the doors to higher education for millions of Americans, paving the way for the federal student loan programs that followed. What started as a way to level the playing field gradually morphed into something else as college costs skyrocketed and borrowing became the norm rather than the exception. Today, the US stands out among advanced economies for turning higher education into a debt-fueled gamble. But that shift didn't happen by accident. With the federal government guaranteeing student loans, colleges and universities quickly realized they could ramp up fees year after year, knowing that students could always borrow more to cover the rising costs. The result? Over the past 2 decades, the total amount Americans owe in student loans has soared, from under $500 billion in the early 2000s to nearly $1.8 trillion today. That's a more than 3-fold increase, and perhaps the clearest evidence that easy credit hasn't just helped students, it's also allowed colleges to charge more than ever before. Today, nearly 43 million people are on the hook, with the average federal borrower owing more than $38,000. For many, it's a bill that arrives before their first paycheck and lingers well into middle age. And for some, especially those who pursued graduate degrees, balances can easily top 6 figures. While the pandemic brought a brief relief under the Biden administration, with payments and interest paused, in 2023 the bill finally came due again. Collections have resumed, and the results have been striking. Over 1 in 5 borrowers, more than 20%, are now 90 days or more past due, which is a record high. That's almost double the delinquency rate seen before the pandemic began. Worse, millions who default could soon face wage garnishment, tax refund seizures, or even reductions in Social Security benefits. But why is this hitting so hard? Well, it's because student loans aren't just another bill. They're often the difference between financial stability and falling behind. Most borrowers pay between $100 and $300 a month, but some face payments of $1,000 or more. With other costs of living on the rise, even a modest payment, therefore, can tip a household budget into the red. And, unlike other forms of debt, student loans are notoriously difficult to discharge in bankruptcy. The politics, meanwhile, are heated. The Biden administration cancelled more than $180 billion in loans for select groups, but broader forgiveness plans were struck down by the Supreme Court, and the new administration has moved to limit access to loan relief programs. Meanwhile, a record number of Americans now say that they would use any student loan forgiveness simply to pay down other debts, a sign that the problem is less about education and more about the broader squeeze on household finances. There's also a generational angle at play. The largest absolute debts are now held by Americans aged 35 to 49, often parents themselves, still carrying their own student loans while navigating college for their kids. For many younger Americans, the promise of a degree being a ticket to the middle class feels increasingly hollow as they see high monthly payments, stagnant wages, and the dream of home ownership slipping further out of reach. But while it's one thing to talk about Americans taking on record levels of debt, it's another to ask who actually owns these obligations. Let's start with the basics. Credit card debt is typically owned by major banks. Think JP Morgan Chase, Capital One, Citigroup, as well as an expanding cast of retailers and fintech firms. Mortgage debt, though, is a bit more complicated. Your bank might issue your home loan, but it's often sold on to government-sponsored enterprises like Fannie Mae and Freddie Mac. These institutions support over 70% of the US mortgage market, providing a constant flow of credit but also intertwining household finances with Wall Street. These loans are then bundled into mortgage-backed securities and snapped up by pension funds, insurance companies, and global investors. Student loans are even more concentrated. Over 90% of this market is now held by the federal government, specifically the Department of Education and, by extension, the US Treasury. The remainder is with private lenders, banks, and state agencies. When federal student loans go unpaid, it's not just private lenders taking the hit, it's taxpayers, since these loans are ultimately guaranteed with public money. And what about buy now, pay later? Well, BNPL debt is still a bit of a Wild West. Most of it is held directly by fintech companies like Klarna, Affirm, and Afterpay. They either keep these loans on their books or sell the receivables to banks, asset managers, or increasingly to third-party investors through securitization. The true ownership and risk exposure can be opaque, and if a wave of missed payments hits, these fintechs and their investors take the initial losses, but the impact can ripple out to the broader financial system. But what actually happens when people can't pay? Well, the first step for banks, card issuers, and BNPL providers is usually a charge-off, wiping the bad loan from their books, though it's hardly a victimless act. For every dollar not paid back, the cost of borrowing creeps higher for everyone else, and access to credit can tighten. Meanwhile, in the mortgage world, widespread defaults mean foreclosures, which can drag down home values, stress financial institutions, and even shake confidence in the broader economy, which we saw vividly play out during the 2008 financial crisis. So, what does all this debt mean for the economy as a whole? Well, the fact is that in 2025, Americans are spending over $560 billion a year just on interest payments alone. To put it another way, Americans now collectively work 18 billion hours a year just to service the interest on their debts. The growth rate of these interest payments has outpaced wage growth by a factor of 5 since the 1970s, meaning an ever larger share of household budgets is eaten up by debt rather than spent elsewhere. And that squeeze has real consequences. Consumer spending makes up nearly 70% of US GDP. So, when more paychecks are going to banks, mortgage lenders, or the Department of Education, there's less left for restaurants, retail, travel, or new businesses. And we're already seeing signs of a slowdown. Retail sales growth is flat, auto purchases are softening, and even the housing market is declining in key cities. Delinquencies add further fuel to the fire. When someone falls behind on one debt, they often start missing payments on others. As of early 2025, more than 1 in 5 federal student loan borrowers are 90 days or more delinquent, a record high, and credit card delinquencies have started to climb after a historic lull. These missed payments ripple outwards, making banks more cautious and tightening the flow of credit throughout the economy. If defaults rise sharply, then banks may pull back on lending, making it harder to get a car loan, a mortgage, or even a business line of credit. Higher risk for lenders means higher interest rates for everyone, tightening the squeeze on both consumers and companies. This is how a consumer debt crunch can evolve into a broader slowdown or even a recession. Now, of course, it's not all bad news. Many homeowners have locked in low rates and are sitting on record equity, and some consumers are paying down balances. But as interest rates remain elevated and the labour market cools, the risk is that debt becomes a drag not just on individuals and families, but on growth and optimism across the country. Periods of rapid debt accumulation are often followed by periods of painful deleveraging. And what makes 2025 unique is just how many Americans are feeling the squeeze at the same time across credit cards, BNPL, mortgages, and student loans. So, while we may not be on the edge of a dramatic crash just yet, the era of easy money is clearly over. And the long, slow squeeze of debt servicing may be the story that shapes the US economy for years to come. And if you want to know how sovereign debt plays a part in all of this, then check out our video on financial repression right over here. If you haven't subscribed to the channel yet, you can do so down there. Okay, thanks so much for watching, and I'll see you again very soon. This is Guy, signing off.